I mean, Bruce Springsteen on a mid-August day in the summer. What a pleasure. Shirl, Penney, pleasure for you, to have you with us. I'm Caleb Silver, the editor-in-chief of Investopedia. We're so delighted to have Shirl Penney, the CEO of Dynasty Financial Partners, with us for our advisor webinar series. Been trying to get a conversation going with you for a while. There's been so many fascinating things happening in your world and in the world for RIAs, and we're just delighted to have you. So welcome to our webinar series, and just hoping you tell us how everyone in your network and your family is doing through all of this.
Thank you, Caleb. Appreciate you having me, and thanks for the Springsteen lead-in. That was great. Family is wonderful. Business is as well as could be expected in this environment, and I hope the same is true for you and your team.
We are blessed, and we feel pretty fortunate, and so far so good, but we know we're not out of it. Well, we're delighted to have you again with us and to talk about the changing landscape for RIAs. We have so many of them that are friends of the site, that use Investopedia, that we celebrate through our Investopedia list of 100 most influential advisors. And you know this network well. You know a lot of the same people as we do. So we're going to share a full screen so we can have a conversation. Folks on the call, feel free to chime in with Q&A. We'll get to as many as possible. And we'll save a little time at the end if we don't get to all of them. And then if we don't get to them and you still have questions, you can email us through our events page, and we will make sure that we get those over to Shirl and his team if they are for them. So again, thank you for being with us, Shirl. And let's see if we can share this screen without breaking anything. All right, are we on the full screen mode here? Again, delighted to have you. I want to talk a little bit about Dynasty Financial Partners and your path to becoming the CEO of that, which is not like any other path we usually hear about in the world of money management. So let's start with you, Shirl Penney, how you got here. It's a fascinating journey. I'd love the folks on the call to learn a little bit about you, and then we'll talk about Dynasty and what Dynasty is all about and where it's going.
Yeah, the real quick backdrop, and I'm guessing, Caleb's a little bit why you played Springsteen, Born in the USA. I definitely consider myself as someone who's fortunate enough to be living the American dream, and I know we all are in our own way, but grew up in a small town in Maine, no parents, orphaned, actually homeless for a bit, bought a suit for $13 at the Salvation Army, rode a bus to New York, and got hired at Smith Barney and Citigroup, where a legend, Sandy Weil, was building at the time, the largest financial firm in the world. And I saw an opportunity to help bring all of the services of the organization together to support the advisors. And that was kind of the early stage beginnings of building out a wealth management movement. The industry obviously went from commissions to more professional asset management to more wealth management. And I was fortunate enough to be a young person kind of working on an initiative to help drive wealth management there. But I saw all the firm's top clients were entrepreneurs, and always fantasized about sitting on the other side of the table and leveraging my skill set, which was building capabilities for some of the industry's best advisors, and wanted to do it on the independent side. And I know you want to talk more about this later, but it was clear, this is back, 15, 20 years ago. The data was clear then, and it's obviously become even more so now. But there's been an ongoing migration of both advisors and assets. The press talks a lot about breakaway advisors. They don't talk as much about breakaway clients, clients looking to go and get advice separate from where products are manufactured and sold. But that movement has been accelerating dramatically, actually, over the last 10 years. And we built Dynasty Financial Partners to take advantage of some of those macro trends and to build resources and capabilities to power some of the best advisors to take better care of their clients in the independent space.
And your timing seems to have been great given what's happened in the industry. So just by the numbers, our registered RIAs reached a record high. This is the 2019 Cerulli report data, I believe. 3.3% increase 2018. 43 million clients, $83.7 trillion, just a little bit of money under management there. And then there's so many independent and hybrid RIA firms that have been forming over the last few years. So your trend, you were right on top of the trend there. Could you see it happening being inside a so-called big conglomerate bank, but what we call wirehouses these days. Could you see that break off happening before you broke off, so to speak?
Yeah, it was in the early stages. We started having these conversations about 15 years ago. And you did have some rugged individualists, some advisors that had started to make the move to independence. But the historical independent RIA space, you go back 15, 20 years ago, was a little more retail in nature, servicing a smaller end client with an advisor who had a smaller size book of business. And rightfully so, all of the capabilities were built to support that type of business. And what has really accelerated the overall migration in terms of advisors, but really client assets, are now the larger advisors. We've helped facilitate many, billion-dollar plus breakaways where advisors are going independent and taking, the groups of their clients. The personal mission for me is what I, realized, back in all those client meetings 15 years ago. And I had the good fortune of meeting some incredible people that were clients of Smith Barney at the time. The way they talked about their wealth management, they had these family offices, and they talked about having people who just work for them. Separate from where they were getting advice, they had a custodian where assets would sit safely. And then separate again, kind of a triangulated advisory model, they could go out and get product. Any asset manager, they could shop a trade or a loan, any bank or capital market desk, et cetera. And then they had technology that tied it together. And when we were drawing up the business plan, Caleb, what really spoke to me about Dynasty is if we could aggregate together a network of like-minded advisors and get to scale, we could democratize the triangulation of advice. So if you were even a couple $100,000 client of an RIA that was powered by Dynasty, think of us as that Intel chip that's helping to power them, because now we have an aggregate approaching $50 billion on the platform. That $50 billion buys us a lot of access and clout and buying power around the street, so that an underlying consumer of any of the firms that we support can get that triangulated model that historically was only reserved for that billionaire type family office client.
Right, and technology has only accelerated that because you have all these great platforms that have come on the market that help advisors and planners have these conversations with their clients and really help them sort of visualize their own financial plans and their own asset allocation. And we'll get into some of your big partnerships soon. But
Caleb,
I think that, again, it was...
If I could just draw one easy point to kind of highlight this migration.
Sure.
So when we started Dynasty 10 years ago, let's look at Schwab, right, which is one of the largest custodians in the space as a barometer. They had roughly 500 billion of assets on their RIA custody platform. Roll the clock forward when we started the business, that was 10 years ago, to today. They're approaching, and this is before the TD merger, just organic growth, they're approaching 2 trillion. So they have been net asset positive, and this is just one data point and one custodian, right? The others have experienced a lot of growth as well, but they've added 1.5 trillion in 10 years. That's more assets than some of the wirehouses have in total. So they've onboarded more assets in the RIA channel by both onboarding new clients, organic growth of the 8,000 or so RIAs that they service, as well as bringing new entrants into the space. More assets than it took, decades for some of the wirehouses to build. It's just fundamentally a better model when you separate advice from where products are manufactured and sold, as evident by clients and advisors voting with their feet and their dollars. And that's why assets are only flowing one way in the industry right now.
Right, and then you make sense when you see some of the bigger other roll-ups with the United Capital going to Goldman. They want those assets under management. They want those relationships with clients that go back generations in some cases, and they want the future relationships if and when wealth transfer happens to younger generations. So what a perfect storm of things going on in the industry. There are several what we call RIA networks. You're not necessarily one of them given what you do, but I do want to have you help us differentiate what Dynasty Financial Partners does versus a Hightower, versus a Focus or an LPL or Raymond James. So let's start with what they do that you don't do, and then what you do that they don't do.
Sure. So when we came into the space, a little over 10 years ago, we invented the platform service model. And everyone at the time, since when you invent a new category, people want to compare you to other businesses they've seen before. So whether it's a Focus or Hightower, you mentioned United, and I would consider myself, friends with the leadership team at those firms, fellow entrepreneurs in the space. We have a lot of respect for each other, but they're buying businesses. And then the advisors ultimately work for that organization. They're buying the equity, they're buying the books of business. Dynasty does not do that. Dynasty is a service provider. So what's fundamentally different from a traditional roll-up in the space versus a service provider is we work for the advisor. The advisor doesn't work for us. And we have to stand and deliver on their behalf, just like they do for their client, or we get terminated or fired. There's no ownership that locks them in place. So we provide all their technology in the middle and back office. We provide debt and equity capital if they need it without owning the business. We provide all the TAMP services if they need SMAs, UMAs, access to alternative investments, and then the value-added business components, which is being in a network of like-minded advisors, practice management, coaching, et cetera. And then, with LPL, who are neighbors of ours, obviously in St. Pete, just an incredible corporate citizen there. LPL, they play in the RIA space more as a custodian. So they would compete, with Schwab, as I mentioned, or Fidelity, Pershing. So they're more in the back office. So think of the advisor in the front office, Dynasty in the middle office, right, doing all the bringing all the technology and research and trading tools and everything to run a business, sitting there, and then the custodian sitting in the back office.
Right. And it sounds like, and I think I've even read this in some of your mission statements and definitely heard you say it in public at conferences, that you really take care of all of the things that an RIA would like to not have to deal with, so they can do the thing that they like to do, which is help people with their money, help people with their planning, help people, attract new clients and retain the old ones. Am I right?
That's exactly right. And which is why, frankly, Caleb, one of our fastest growing businesses right now is RIAs outsourcing to us. So not breakaways, but legacy RIAs saying, you know what, I'm overstaffed. I want to get my fixed cost in line from a staffing perspective. I'm spending too much time juggling 67 different vendor balls. I want to outsource to an integrated stack to do exactly what you just said, which is to free up more of their time to take care of current clients, to strengthen those relationships, and to go get new ones. Or perhaps, in increasingly cases, free up time to drive inorganic growth, meaning to go do M&A. And we might spend a lot of time helping them get what we call M&A ready, getting their structures and capital and employment agreements, operating documents, everything in a good place so that they can go out and start to add other advisors to grow inorganically alongside of their organic growth.
And the model they pay is on a subscription basis or a fee for service or a retainer? How does it work?
Sure. So we have 4 businesses. One is a consulting business, so they pay on the project. Launch a business, they pay, for us to project plan it, be the general contractor, if you will, help them get ready to sell their business or succession. They can hire us as a consultant. We have a capital business, so if they borrow money, they pay us spreads on the capital interest that's there, pretty straightforward. If we buy a revenue interest in the firm, they pay us a revenue interest in exchange for the capital up front. The core services, which is running that middle and back office, that's basis points on assets. That starts at around 15 basis points and tiers down, in some cases, multiple billions on our platform. It can get below 10 at scale, but they don't have to pay or manage the underlying vendors. We do all of that as part of that package. And then the last business, totally a la carte, is our TAMP. So if they use our SMAs or our investment platform, or if they use us to help them shop a loan or a trade, et cetera, help them on the insurance side, their client would pay for us to help them there.
So that core service is staffed by Dynasty Financial staff who handle all of this back end middle office work across hundreds of RIAs, if not thousands, right? They're dealing with multiple clients.
Yep.
But obviously the processes are in place to scale unlimited. Am I right?
Yeah, I mean, we're reasonably selective. We do say no. It has to be a good fit, to come on board. We're adding anywhere from 12 to 15 new. You think about our growth at the home office, we're adding 12 to 15 new firms a year. We might do anywhere from 10 to 20 tuck-ins or M&A. And then we're helping all of our firms grow organically, right? So collectively, that's added up to pretty aggressive growth to keep our team busy. But you're right, fundamentally, what we do is we provide what we call synthetic scale. And we've done a lot of studies on this, looking at RIAs when they come in and plug in to Dynasty, and then looking at them going forward or working with other outside consultants to get data from them. What we find is, on average, firms that are powered by Dynasty, RIAs of equal size, are close to 500 basis points more profitable. And the reason for that is because they have lower fixed costs. They don't have to hire as many people because they're leveraging our team versus having to hire a bunch of people locally and then manage them. And then obviously they pay a little bit less, with some of we call them resource partners or vendors that need to come together to help them execute. And then equally as important, the best advisors, Caleb, we find want to be independent but not alone, right? They want to be in a community of like-minded principals. Nobody has a monopoly of great ideas, obviously, in this industry. So being around people who want to share and say, here's what's not working for me, here's what is working, and really grow together. We're really blessed with a fantastic community of like-minded professionals who really do take pride in the collective growth of what we've done together over the last 10 years.
Yeah, I have met many of the partners and the teams in your network, and they all say the same thing. And it's really about that, right? Everyone is trying to run their own business very effectively in a time of change for RIAs, but having that network both rely on for services, but also the intelligence sharing that goes on firm to firm and through Dynasty is quite incredible to watch. I've seen it happen at various conferences. Let's talk a little bit about how this pandemic and this transition to everybody working from home, the lack of business travel, what it means for RIAs who have been sitting and holding expensive real estate for a while. How do you think this is going to change the way RIAs operate going forward? And were some of these changes already sort of underway before the pandemic?
Yeah, that's such a great question. And I say to a lot of people that whenever you have a shock to the system, right to the heart of your question, what you find is that it accelerates trends that were already, starting. And we've been pushing our clients for a while to tech enable all aspects of their business. And at various degrees, people were listening. Now they're all listening. You have no choice, right? Whether you're engaged in conversation, with Zoom as we are now, or you're driving marketing on the digital marketing front. You're now investing in your handheld device in terms of how you're going to communicate through digital apps with your clients, et cetera. So that's been a huge part of our focus. The other thing I would say, which I think is positive in terms of really cementing the advisor-client relationship, the last 4 or 5 months, I describe it as the advisor Super Bowl, right? We've been obviously in a long-term, bull market environment. We have a lot of younger employees or a lot of younger, I'm sure, listeners here who've never lived through, a pullback in the market and all the anxiety and stress. And none of us have lived through, a pandemic and a financial crisis all at once. And those advisors that were incredibly present, didn't hide under a rock, were over communicating with their clients and helping their clients stay strong, stay invested, et cetera. They have built relationships, that will benefit them obviously well into the future. I think some things that will change, obviously, one of the big things is real estate. We've seen an acceleration towards RIAs downsizing their footprint or completely giving up their real estate and going 100% virtual. We've seen more breakaway advisors looking to come into the space because they've said that so much of what they thought they were paying the wirehouse for was the real estate piece. Now they realize, because they've been working from home for 4 or 5 months, they don't really need it. So why are they giving up half of their income for some of those things that they don't need as much? So I think you're going to see an acceleration with technology. You're going to see real estate become far less important in the space. And I think you're going to see people, whether it's M&A or an acquire hire, adding talent, thinking more outside of the box, where you don't have to live in my city, right? You can hire somebody who has the expertise and the talent that you need that lives anywhere. And I've said for a long time, what fundamentally will differentiate one advisory firm from another, and what's very difficult to get commoditized, is quality of service and the quality advice that you deliver. And if you think about technology allowing you to get more local and proximate and deliver better service, and you invest there to make sure you're staying on the cutting edge, you invest in your people and their professional development, and you move your mind from saying they have to live in the exact same location to now the ability to bring talent in anywhere. I think the firms that are the best led, that understand those components, are going to win in this environment in a massively disproportionate way.
I couldn't agree more. And just being able to, instead of having to arrange a meeting at the office in a couple of weeks where everybody's schedules have to coalesce and you can make it over there, is it crazy to think about now that we can just say, are you free for 20 minutes on Thursday at 3? And we jump on a Zoom together and we're done, and we can move on to the next thing. The efficiency that this has helped kind of promulgate has been impressive, but really only for the folks that are able to do it. But still, you find that you can almost get more things done because you're not having to make the arrangements to go somewhere.
Yeah, agreed.
It's been rather incredible. You've been very busy on the technology front and on the partnership front. I want to talk a little bit about two big ones, obviously, that are signature for 2020, but these would be big deals in any year. InvestNet, obviously a big platform business, huge advisor support business. You just announced a plan to launch your advisor services exchange. Tell us what that is, why InvestNet, why this partnership made sense, and then the relationship you have with InvestNet.
Yeah, no, I appreciate that. So when I was coming into the space and started the journey in April of 2008, so started the business in the last financial crisis, really looking at the space, I was examining, the landscape to see who were some of the best entrepreneurs, who were the people that were doing it then that I could really look up to and get to know and learn from. And InvestNet was really off to a great start. I mean, they've continued to execute very well over the last dozen years or so. But I became very close friends with unfortunately, the late Judd Bergman.
Yeah, rest in peace. What a nice man he was.
Absolutely. I love and adore Judd and miss him daily. And Bill Kreger. And spent a lot of time with him early on, and they were very gracious with their time. And essentially said, here's everything we did, here's all the mistakes we made, here's things we think we did right, and if it helps you, then that's great. And we want to encourage other young, I was 32 years old at the time when I was starting the business, we want to encourage other young entrepreneurs. And there were a handful of other partners early on that really believed in kind of the bold vision. As a friend recently told me, you have to have a lot of guts if you're going to name a new company Dynasty. And talk about it being multiple, generations and winning consistently over time, and what our name, means to all of us. And they were hugely supportive, before we launched. And they've been an integral part of our infrastructure and tech offering the entire journey for Dynasty. So when we sat down and started to have a conversation with them, we were trying to solve for some things, and they were trying to solve for some things. And for them, they were looking at the RIA space, and they have such an incredible footprint there with Tamarack, which is really a dominant player, from a trading, reporting perspective with RIAs. But a lot of their clients were looking for additional value-add services on the business side, marketing, compliance support, M&A support, capital. A lot of things that we did and did fairly well. So we started to talk about how could we partner to bring those capabilities to their current clients. And then when we just looked at the legacy relationship that we had, we were in the conversations of doing our fifth capital round, and we just decided it made sense for InvestNet to make a small minority investment, which is our first outside investment that we've taken, our first kind of institutional investor, and given the strategic nature of that relationship, we thought it made sense. And then Bill Krager, who, as I said, I think is one of the finest entrepreneurs in the space, joined our board. So we're very fortunate to have somebody with his history and experience on our board. And then with Marty Bicknell, Marty also one of the best entrepreneurs in the space, someone that I really admired. If you think about less than 15 years ago, Marty was a breakaway advisor, less than 300 million in assets, goes independent, and then from incredible and remarkable organic growth and inorganic growth through M&A, builds Mariner into one of the largest national RIAs in the country. Again, in less than 15 years, to have over 30 billion in assets, just an incredible story, and did it all, based in the Midwest. And we were talking to him about an issue he wanted to solve, which is so many of the advisors that are coming to them maybe don't want to sell today, but they want to leverage the remarkable brand that Mariner has built. They want to leverage the practice management, the investment acumen. They want to be in the community, but they don't maybe want to sell. So we created a 1099 model called Mariner Platform Solutions, powered by Dynasty. So you get the best of both worlds. You get Mariner support in leadership and practice management, investment acumen, portfolios, et cetera. And then you get Dynasty to deliver all the middle office and the TAMP services. And Marty, who's a serial entrepreneur, really believes in the space, wants to participate in a lot of different ways. As part of that last investment round, said, look, we're going to partner in a massive way together. Could I maybe join the investment round with your legacy investors, with Envestnet? And we said yes, just because they're going to be such wonderful partners and strategic advisors on how we can continue to build a better offering to take care of our growing network of independent RIAs.
Yeah, these are great partnerships, and unlike a lot of others, these are organic. They come from the service provider place where you're just really trying to make it easier for RIAs and advisors to run their businesses. So it seems natural. And if folks don't know the scale and the capabilities of the Envestnet platform, it's worth checking out. Ask your financial advisor. If you don't have a financial advisor, you should, because these tools have really revolutionized the way that individuals and families plan, and the way that RIAs help them answer and solve some of their problems. Obviously, there's been a ton of M&A in your space, in the RIA space in general, a trend we should probably expect to see growing as we go through the balance of 2020 and into 21. But even in the last few weeks, there has been deal after deal in this space. What is it the pandemic? Is this combination, this perfect storm of all of these things coming together that's driving the M&A in your industry?
Yeah, you used the term earlier, which I thought was really good, the perfect storm analogy. It seems like it's a bit of a perfect storm for M&A as well. Rightfully so, there was a cooling off in the second quarter. I said it was the advisor Super Bowl. Really what I'm saying is advisors were focused on clients, as they should have been. But I think with the market coming back as quick as it did, I think there's a lot of advisors that we're talking to that maybe were thinking about transacting. And maybe for the last couple of months have been a little bit worried that maybe they missed their opportunity. So there's a new sense of urgency because there's still in every one of these transactions, Caleb, we're still seeing far more buyers coming to the table. There's look, the RIA space has been discovered in a major way. So whether it's strategics, financials, private equity, it can be asset managers, sovereign funds that are in the space, well-run, very well-capitalized RIAs like Mariner who have their own capital. I mean, there's so many options that are out there. It's definitely a seller's market still. But I do think that advisors are realizing that scale is a big deal, whether you're in the back office like Schwab in the TD deal, whether you're in the middle office like Envestnet buying Tamarack or Money Guide Pro and some more of those assets to help invest in them, or whether you're Mariner in the front office and you're an advisor with a couple $100 million selling to Mariner. Now you have a bigger brand, more marketing support, et cetera. And the cost. I mean, this is an interesting stat too. We looked at 10 years ago, our average underlying client is about 5 million, average client of an advisor that we support. The ROA, the return on assets, 10 years ago was 76 basis points. Today, 10 years later, it's only eroded 4 bips to 72. So everyone talks about margin compression, but what's happening, it's not on the revenue side, actually, it's on the cost side. So in that same 10-year time frame, the expectations, right? It went from asset management to wealth management. I want a financial plan, help me on the debt side, right? So all of the service requirements to get that 72 basis points have gone up, right? So that's why scale matters, because it allows you to manage the cost side of this business down better, right? To ensure that you still have healthy margin in the business, which is why if you're a small RIA, you have to be thinking about over the next 5 years, how's that going to impact me? There might be some ways that you can delay it. Firms like Dynasty provide synthetic scale, so you get the benefit of being in a large organization without having to sell. But I would encourage anyone listening to think about what's my scale strategy, what's my economic model going to look like if I have erosion, right, on a gradual basis on the revenue side, but acceleration on the cost side. And how am I going to deal with those issues within my business? I think it's one of the key fundamental things facing all of us for the next 10 years.
Right. But as we spoke about earlier, the changes that the pandemic has brought on, where all of a sudden, if you realize some of those expenses may not be as necessary, could improve margins, but it's only going to probably continue this trend of acceleration in M&A because the business has become more attractive.
That's true. The real estate piece will go down. That's usually the second biggest line item on the fixed cost behind staff. And to the other point we talked about, you're spot on. If you're an advisor in St. Pete, Florida, down the road from us, you may now look to acquire a firm in Texas, right? Or you want to have an outpost in Colorado or wherever it might be. Technology is going to allow, I think, the creation of national independent RIA brands a lot quicker than what we've seen in the past.
Right. Just looking at the distribution of assets and what a lot of the RIA firms are sitting on top of in terms of those legacy clients. There's a fair amount of money out there, and we're seeing also this movement, as we talked about at the beginning, of the wirehouse brokers breaking out, as they call it, and going independent. But it's all sort of heading in the same direction, and you have built a firm that's sort of kind of waiting for that to happen, which is very interesting. I was gonna, you can't help but notice the fact that private equity has become very interested in this space. If you look at a Hightower, or if you look at some of the other firms that have attracted that kind of capital, and when that first started happening, it didn't seem that logical to me. But the more I learned about it, the more it makes sense given some of the recurring cash flows. But if you're a private equity firm, what is so attractive about these businesses, especially the larger ones with the high net worth asset clients under management?
Yeah, there's a whole host of things, but predictability of revenue, especially if the business is primarily advisory. You also have a business that is essential to our country, and becoming more essential, right? With so much of the country, frankly, being financially sick, whether you're talking about governments, pension funds, or individuals across the wealth spectrum. More people need quality financial advice today now than ever, and you have fewer and fewer advisors, which you see here on this chart. The only demographic that's growing are RIAs, and I'll be honest with you that they're not growing fast enough. I mean, no one in the industry is doing a great job of attracting new talent. So you have a supply and demand imbalance that's very attractive to a professional investor, because it's an industry that's needed. It's annuitized revenue streams, like I said, that are very predictable. You've got underlying wealth that's growing. You've got a handful of firms that can consolidate clients, growing organically, leveraging technology to service them better, and can grow inorganically by adding other advisors underneath of them. I mean, you have maybe some tail risk with massive dislocation that could come about with some of the large consumer technology companies maybe coming into the space. But if you're looking at to invest in wealth management, you have to have a thesis around the RIA space. As we've been talking about, all roads lead to RIAs, whether it's clients, which is kind of the way this industry keeps score with assets, or advisors. I mean, you don't have a lot of competition. So if you can own a high quality asset that's an RIA that can grow organically and inorganically, you're going to do well, because what you're also seeing is the margins expand as you get bigger, and the multiples of valuation get bigger as well. So you can get both of those things, working in your favor if you're a professional investor who can partner with an entrepreneur to help them execute that.
Folks, feel free to submit questions into the Q&A platform, into the chat platform. We'll get to as many as possible. A couple of them have come across and were exactly what I was about to ask. So we're mind melding on that, but we have about 10 minutes left. So I'd love for folks to submit questions if they have them. I also want to talk about this, this thing that the entire wealth management industry has been talking about for 10 years, wealth transfer, the 34, 37, 50, $100 trillion, whatever it is, transfer of wealth from older generations, silent generation and the boomers, to younger generations that'll probably skip mine, but to younger generations. And then there's this hand wringing about the fact that, younger clients or the children of your typical RIA clients are not going to want to maintain their parents' financial advisor or get advice that way. We haven't really seen that yet, but is that something you're concerned about, or are you seeing any evidence of that through all of the RIA partners under your umbrella?
Yeah, look, I'm a big believer in only the paranoid survive, so I'm concerned about a lot of things on behalf of our clients. Yes, I mean, look, you need to meet people where they are. And by the way, I also don't necessarily subscribe to the notion that it's only the younger generation that want digital tools. I think, there's plenty of older generations that want access to their information in an easy to understand format that maybe sits on their handheld device. But I think investing, in time to get to know the next generation is very, very valuable as you think about succession planning for your business. I think so many people run their practice like a practice, not a business. And sometimes it's the case of the cobbler's shoes, right? We're not doing all the things that we might be recommending as an advisor to our entrepreneur clients. But I think there is, I mean, the numbers are the numbers. There's going to be a massive transfer of assets that's going to occur. And we should be thinking about diversity within our business that looks like our clients, right? And that means younger generations that can connect well with the next generation within the family that's going to be receiving the wealth. We've all seen the statistics. Women live longer than men. There's also going to be a massive wealth transfer to where, I've seen, Shirl studies and others that would suggest that inside of the next 20 years, the majority of wealth, as much as 60% of wealth in America, will be controlled by women, right? And again, if you subscribe to the notion that people want to work with people that they can relate to, then clearly our industry is woefully underrepresented with women. And I would encourage all business owners to look at, not just because driving diversity, whether it's people of color or adding more female employees, because it's the right thing to do. It's necessity when you think about the next 20 plus years in this industry, because the wealth diversification that's going to occur across our country, right, is going to look very different than it looks today. Therefore, the people servicing those clients need to look very different than what they look like in our industry. So I think there's an incredibly strong business case that you can layer on top of the fact that driving diversity, in our industry is something that needs to happen, regardless of the business case. But I think it's unique in that they're both there. You
said it. So diversity across male, female, and multi-gender, but also looking at the broader diversity across race, where financial services, financial media are woefully underrepresented, and we all have to do a better job. But you're right, because this is not going to be a one-way transfer only to a certain group of people. This is a lot of wealth, and a lot of people have different needs, and they're only going to get more dynamic, especially as we hopefully come out of this pandemic, and think about the way we want to restructure our lives. If you think about those folks that are just giving up on big cities, giving up on complicated practices, on careers where it requires you to go into a place, to a busy place. So many changes are going to happen. Let's talk about Dynasty and your vision for the next, let's call it 2 to 3 years, and then looking out 10 years. You've built something incredible here. It's you're partnering with some of the top organizations in the world. You have a ton of respect across the industry. I know you're nowhere close to being done, and you're super young. So what do you have in mind? Like, what is your North Star looking at 2, 3 years, and then let's look at a decade from now?
Yeah, no, I appreciate that. I'm 43, so I like to think of myself as still super young. So thanks for that. Look, in the most immediate term, I've always thought, to execute the vision in terms of the broad access and to allow us to really invest heavily in more talent and technology to support our clients, that it's been a race to 100 billion. So that's a number that is near and dear to a lot of the founders because it's the number we always talked about. And what's interesting is it took us 5 years to get to our first 10 billion, and then 2.5 to get our next 10, and then 2.5 to get 20, right? So we've just been the speed of an acceleration of asset growth, which makes sense because we're growing inorganically with our underlying firms and organically and adding new firms. So hopefully we'll get to that 100 billion pretty quickly. I think longer term for us and for the industry, where we all need to head is towards this notion of cyborging in the industry, where human empathy and judgment for key life events that you're advising somebody around their money, I think is going to be very important. And as I said earlier, investing in the competency and the quality of that advice is something that you can really differentiate yourself around, while at the same time using automation and technology to streamline a lot of the things that can be more commoditized, whether it's trading and reporting functions, automating some compliance support, business operations, et cetera. So I think the best run firms will be the ones that get those things right. And I think in the next 5 years, not even 10, I think it's a digital business. I think pretty much everything will be done through a digital interface. The need for physical office space will dramatically diminish. And I think you'll have advisors who cover clients all over the world with talent that exists within an organization that also is leveraged on a global basis. So I'm extremely bullish on the industry, the growth. But as I said earlier, I think we have to be. If we believe in the American dream and we believe in the importance of financial advice for all Americans, we have to be bullish on this industry. And it's on all of us to make sure that that we advance it, for the betterment of not just the people in the industry, for all the clients and people that we serve.
You said it, and all the smart advisors that I talk to, especially the younger ones, they talk constantly about holistic financial planning. It's not asset allocation. Yes, that's part of it. It's not college planning. Yes, that's part of it. It's not life care planning or healthcare for your parents. It's everything. And the conversations around money are so multidimensional now that the best firms are the ones that are providing those scale of services with a human touch, even though we might be doing it over Zoom. It's a complete holistic understanding of your money, and some of the partnerships that you put together and what the direction that you seem to be heading in are heading directly for that place where, as you mentioned, it's about everything.
I agree, and we haven't talked about the intersection of healthcare, health and wealth, and how their and access to quality healthcare is so important. Unfortunately, there is definitely a disparity between people who have tremendous financial means and access to healthcare versus those that don't. The more financially healthy we can help more people become, I think the better access to some critical resources that they're going to need, such as healthcare. So I see advisors starting to cross over. Now, they're already starting to, but I think obviously, again, as we said, you face a pandemic, it accelerates some of the trends that are underway. I think you're going to find more and more advisors tying in access to quality healthcare as part of the integrated overall financial and wealth and health plan for their clients going forward.
Right. Does any of that, you're thinking on that, is any of that predicated on what may happen in the next election, or is the fact that healthcare is complicated, was complicated 2 years ago, will be complicated 10 years from now? The fact that it is just integrated into our financial lives, just going to make that the reality?
I think it's the reality regardless who wins. I mean, you do some scenario planning around, which administration, might be in power next year. There are some differences, obviously, from a regulatory standpoint, maybe Reg BI looking at, a unified fiduciary standard, if the Biden administration were to win. But it's interesting, in the scenario planning, I will say quickly, I always say to people, careful what you wish for, because you got to really think it through. A lot of RIAs, like to pound the table, and I get it. They feel like it's right for the consumer around driving a unified fiduciary standard. But that's one of the fundamental advantages that an independent advisor has now versus a captive one. And you may lose some of those competitive advantages if it's now just more difficult for the consumer to know the difference. The flip side is, and I've some of my best friends in the industry work at the wirehouses. Be careful what they wish for too, because it's very difficult to execute a fiduciary-based model in a captive world. If you're got a Coca-Cola executive and she wants to sell her stock, if you only have one sales desk that you can go to because you're selling away if you shop it out, how can you be a fiduciary in a world without choice? So does that accelerate the spinning off of some of those wealth management businesses, right? Or advisors feeling like they need to move to be a quote unquote true fiduciary. So it's interesting to play a little more chess sometimes than checkers in thinking through some of the downstream ramifications of some of these changes. So it's fascinating to think about. We'll see, but specific to your question around health, that's obviously going to matter regardless of who wins, this November.
I couldn't agree more. And we're back on camera, but I really want to thank you for your time, Shirl. I do want to have you back. We'll definitely have a conversation about regulation and where that goes and how RIAs will fold into that and work with that after the election. So I hope you'll come back and join us again in December or in the early part of 2021. Hopefully we'll be on the other side of recovery here for the United States, and the rest of the world. But we do appreciate your time and all the insights you shared with us.
Thank you. And I'm excited to be able to do this. We see the Investopedia, website up around our office all the time. So I was thrilled when you asked me to join. I'm glad that we were able to make it work. So thank you very much.
All right. My best to you and your team and your family. And thanks again. And we came in with a Little Bruce. We'll go out with a Little Bruce, different song. And I wish you all the best for the rest of the summer and continued health and success.
Thank you so much, Caleb.